Hello everyone, welcome to the Stock Hacker channel. I'm Erwin. This is Joel.
Hello, how's it going?
I'm excellent. Hope everyone else is excellent. Market's rocking.
Oh, rocking down.
Rocking down. Just yesterday, as we're recording, yesterday was the Fed announcement. Jay Powell increased interest rates 0.5% as expected, and now today's the day after. Market's tanking, giving back all those gains. But yeah, that just means, like my mentor says, pray for when stocks or stock markets crash, because that's when you find the most opportunities. And I am screening for opportunities. And that's one of the things we're talking about today. And again, actually, since we're talking about beginners today, I think that's what people need to understand. The great analogy often here is when people are driving around, when they see gas is cheap, they're excited, right? When they see it's expensive, like it is today, I saw $1.91, they're upset, right? It should be no different with stocks. When you see stocks are cheap, that you should be excited. That should be the mentality of any investor, not just beginners.
Yeah, absolutely. And we're going to talk about investing versus trading. You can make money at both. There, you have to have a specific mentality for each, though. Mm-hmm. So we'll break that down. A lot of people get excited about the idea of trading, or they might balk at investing, long-term investing, but they both have their benefits. And we'll start with a direct analogy to real estate investing, and so that for you real estate investors out there, you can get a hold of this really quickly, and then we'll break down the mentality and some of the practical and tax differences between investing and trading as well. So which is better? And this is a question for, as you start to research the stock market and how to make money in the stock market, you quickly find out that you're going to get inundated with, well, probably spam from people wanting you to follow their trades and their day trading and stuff like that. Then you'll get a lot of the value investors who are very set in their ways about exactly what the criteria are to buy and never sell. And so what are you going to do? What is your approach going to be? So which is better? It's up to you. Do you want monthly cash flow, or are you looking for appreciation over time? Do you like the high risk, high reward environment, or do you want slow and steady growth? Do you want tax advantaged investing, or does it matter to you if it's active income? And then do you like that exhilarating ups and downs, or do you never want to look at your account? So if you can answer those, if you can pick between those, you're going to really quickly understand if you're an investor or if you're a trader, or maybe you fall somewhere in between.
And the nice thing about all these things is you can try it all and make believe money as well, which is highly suggested.
You can open up a paper account. We use Interactive Brokers. I started in paper for months before I ever started. I do some option trading and investing, and got used to everything there. Made mistakes there before I made mistakes with real money. So, it's not to say I didn't make mistakes with real money, but the beginner mistakes, anyways.
Yeah, mistakes hurt a lot less if it's not real.
Right. So the analogy is, for you real estate investors out there, investing is like buy and hold real estate. Buy a rental, hold it forever, or for, as long as you need to, maybe until you want to retire or you want to pay for your kids' education or whatever.
Yeah, just like Warren Buffett says, if you don't buy a stock unless you don't plan on holding it for 10 years. I treat my real estate investing the same way. My intention is to hold it for at least 5 to 10 years.
On the other side of that is flipping. That would be like stock trading. You're in and out relatively quickly. And you want to make a lot of money in a short period of time, but you're also willing to do more work. You're willing to put in the work to up the value. Obviously, you're not going to be increasing the value of the stock, but you are putting work in advance to identify the stocks or identify the opportunities anyway for growth or quick growth. Mm-hmm. And
it's time sensitive.
Yeah.
You have to be active. You have to be keeping an eye on it. I was speaking to a flipper yesterday. In the real estate market we're in right now, the market's going down. I think he's being ambitious. He seems to think he knows what he's doing, and he probably does. But again, he's investing. He's buying real estate in a downward trending market. So you gotta be quick. No different than if you're trading and the market goes against you, you're gonna be in trouble quickly.
Side note: if you want to, we did an article on what to do if the market crashes. Some of the options you have. If you want to check that out, it's on our blog at stockhacker.ca. If that worries you at all. So the first and probably one of the more looked over elements or differences between investing and trading would be taxes.
Yeah. And this isn't accounting advice, folks. I've been banned for giving accounting advice.
His wife's an accountant, if you didn't know that.
If you buy and hold real estate, and if you buy and hold a stock, when you eventually go to sell it, that'll be considered capital gains. So you only pay gains on tax on half of those gains. That's one of the very amazing tax benefits that our government gives us. And it's one of the reasons I became an investor, is because it feels like the government wants me to be an investor. They're at least incenting me to be an investor. So I'm doing what the government wants and taking care of my financial future.
Mm-hmm. And whereas with flipping, it's considered active income by the CRA, if I got it correctly.
It's active business. It's taxed as active, so it could be taxed similar to your job income.
And that's very similar to stock trading. If the CRA sees you as day trading stocks or being in and out of the stocks quickly enough.
If you look highly sophisticated, then they'll think that you should be paying same thing, full income tax, no different than you'd pay on a job. Of course, there's ways of sheltering these things via corporations, but that's a much more advanced topic for another.
You can go visit Cherry's channel, Real Estate Tax Tips, for that free promo for her.
Speak to your own accountant. Don't listen to us.
Yeah, the biggest differentiator, and so from research. My own research, and again, talk to your accountant, but the biggest differentiator is that if the CRA determines that you are carrying on a business, so this is actually dangerous in your TFSAs or RSPs or any registered account. If the CRA determines that you are carrying on business in those registered funds accounts, there are penalties. And so you got to be careful with trading isn't bad. Just know what you're getting into. Mm-hmm. The difference in risk versus reward. If you're trading stocks, you need to be in and out quickly. And Erwin mentioned that earlier. It can be, when you're investing, you're looking to hold for at least 10 years, or that's the mentality. Maybe it spikes in 2 years and you're like, oh no, I'm fine to get out now. Yeah. Perfect, that's gravy. But the original intent when you get in, I want this for 10, 20 years. But as a trader, you could be in for months, weeks, a day. You know, there are day traders who are in and out multiple times within a day, but that's a lot of work. You got to know what's happening, or rather, you have to know what's going to happen to that stock in order to make money at that.
Mm-hmm. And then what you're going to do if things don't go as planned.
Got to know what your exit plan is and be comfortable with taking losses. So, and you have to be right about the direction. If you're not right about the direction, obviously you lose money. So, and you don't have a whole lot of time to be proven right or wrong. It's either you are or you're not, and you're going to find out pretty quickly. So you're risking a lot. Now, there could be a lot of reward. If you find the stock that pumps really quickly, you could cash out, but you're also taking that risk that it's going to go against you really quick. Whereas if you're just buying and holding, the stock could plummet 20% 3 times in a 20-year period, and you can still end up ahead after 20 years. Same thing with your real estate. You hit plateaus, or the real estate market could even tank for a little bit, and you wouldn't care.
As long as you're comfortable holding that stock and you've done your research and its quality, and a good indication of quality is it's paying you a dividend, which we'll cover in a future episode, then one should be happy and okay to hang on to their investments, and preferably even buy dips.
The biggest way to differentiate this is, as a trader, time is working against you. As a investor, time is on your side. And
time in the market versus timing the market.
Exactly. Yeah.
Timing the market works great too, though, when you can buy dips.
Yeah. If you can combine them both, time the market on the dip and then let time work in your favor. Absolutely.
Right. If you picked up Amazon for $1,600 a share at the bottom of the pandemic crash, you did well.
Very well.
Everyone was scared.
Mm-hmm.
everyone was scared, and I think Amazon's going to outlive me at least.
Yeah, God. Uh, the mentality of investing versus stock trading. So we've already kind of dipped into that, but there are specific mentalities that are necessary as an investor versus what's necessary as a stock trader. So as the mentality of an investor, you want to find quality companies. Someone who's going to, like Amazon, who's going to be around for a while. Warren Buffett has 4 categories that he goes to. And one that always intrigued me was management. Is it well managed? So he's actually looking at, do these people make sound business decisions?
He's investing in people.
Yeah.
No different than real estate investors when they're looking to partner.
Mm-hmm. Buying and holding for decades. So you, again, that timeline mentality of 10 to 20 years. And you're not looking at your account every day. You don't want to have to track the numbers every week or every month even. You're happy to dip in, buy a little bit, leave it alone for a while. Open it up again, buy some more, keep going. And then sell when you're ready, not when you have to. Sell when you're ready to sell. Mentality of a trader is obviously pretty different. You have to be able to recognize patterns in price movement. So it's less about the fundamentals of the company and more about what the market or how the company's stock price is performing. You have to know what your entry and your exit is. So again, like you were saying, you have to have that exit plan and you have to stick to it. Be willing to take losses and try again. It's hard to see red and act on that and take the loss. If you aren't committed to your trading rules, you can blow out your account really quickly if a stock keeps dropping and you don't stop out, you don't sell before it really gets bad. Do you leave money on the table if it eventually recovers? Maybe, but you don't know that. And that's the uncertainty that you have to live with as a trader.
In the shorter term, the more uncertainty.
Yeah.
Because there could be a headline, another company could report earnings or losses and affect your company. The stock market is not your friend. It's not there to help you make money.
Mm-mm.
It's actually there. It almost feels like it's designed to take money from you.
Yeah.
That's why you have to do things that are smarter. For example, take advantage of when the market's being emotional, when it's being excessively greedy to take your profits, when it's being excessively fearful. That's when you get in.
Mm-hmm. As a trader, you're making calculated risks, so it's not willy-nilly.
Yeah, and over very short periods of time. And often traders don't do any sort of fundamental analysis on the asset that they're trading on.
Mm-hmm. So where do you start? So the tax differences, the risk versus reward, the mentality differences, where do you start with, if stock investing is for you, you're like, that stock trading stuff is too risky for me. Where do you start with stock investing? I mean, I personally would start in a registered funds account, TFSA or RSP. I'm going to look for companies I trust. So stuff I already use, like Colgate. I have Colgate toothpaste, or Amazon. I have an Amazon Prime membership. Anybody, if you're an Apple person and you trust Apple, that could be and they're a well-established, one of the biggest performing companies in the market. Could be a good place to start. Not a recommendation, just some food for thought.
I recently bought some Unilever because this is not advice, but a good friend of ours bought it recently. I use their products at home. I use Dove soap. I use Sensodyne toothpaste. The stock is at what I hope is good value, near the pandemic low price, and it pays a 4% dividend.
That dividend is a big piece, but again, we'll cover that. Learn what the essential ratios are. Price to earnings ratio, earnings per share, your debt to equity ratio. There are there are so many of them, and that can be overwhelming. It's okay. Start with one, get used to it, start comparing stocks. And these ratios are fairly easy to either calculate or find. It's information that's pretty widely available. Also, really good tool, TradingView,
Mm-hmm.
and it has a free thing if you're okay with the ads, and they can give you a lot of those ratios too.
Yeah, we use TradingView, but again, you don't have to. You can go in
Mhm.
Yahoo Finance or Google
Yep.
Finance. They have a lot of these ratios there for free.
And so use those ratios to compare companies to each other. And that's one way to say, okay, this one by the numbers, this company by the numbers looks like a better investment for me, for what I'm looking for. That's how you would make, one way you can make an investment decision. Another one is find companies that increase their dividend year over year for the longest periods of time. They're called dividend aristocrats. Dividend kings have done it even longer. Dividend aristocrats in the U.S. increase their dividends 25 years in a row at least. In Canada, the rules are different. They're a little wonky. I don't know why they're that different. The market is obviously smaller in Canada. But there are companies, and we'll cover this in a future video, that have continually increased their dividend more than 25 years in a row. So you can find that. Where do you start with stock trading? It's a bit trickier to answer. You need a lot more education.
I don't even know where you start. I think first you have to ask yourself, are you chill? Can you stay calm when losing money?
Yeah.
I know personally I can't, which is why I personally don't do it. You know, I get nervous over, a poker game with buddies with $5 at stake. So it's not for me. And from our experience, very few people can do this successfully. But those who can are quite good at it.
Mm-hmm. Yeah. And how much time can you give to it? It's work. It requires a lot
Takes
of
time.
Yeah.
Yeah, you need flexibility. You need privacy. As in, this would be hard to do if you were at a 9-to-5 job in the office.
Mm-hmm. If you are attracted to it, though, if this is something that really tweaks you, and you're like, man, I want to figure out how to do that. I think I could do that. The one recommendation I think we could both make is that you actually educate yourself first on stock options, because you can trade stock options just like you can trade stocks. But if you do it right, stock options actually give you a buffer to be wrong. So we said that if you're trading stocks, you have to be right. You don't have to be right on which direction the stock's going when you're trading stock options.
Right. Specifically selling. And
Yeah.
that's why we actually call it stock hacking.
Yeah.
Because for what we do, like we mentioned earlier, the stock market's not your friend. It's actually kind of there to take your money, it feels like.
Mm-hmm.
Which is why what we do is we give ourselves 20-30% buffer.
Mm-hmm.
So then if the market wants to come after us, it would be extremely expensive for them to do so.
Mm-hmm.
So they have much less interest in us, and we're able to make our cash flow on the side.
Mm-hmm. What we do is a mix, is a hybrid of investing and trading. It's not long term, but it's not day trading either. If you're interested in that, we do have a series called Options for Beginners. It's a 3-part series, just introduces you. And it's a really good way for you to dive in and say, is this for me or not? So check that out. It's on our blog. I'll make sure there's a link in the bio below to our Options for Beginners series. And also, if you're a real estate investor, a really good resource would be a report that we just released. It's Cherry's story. It's a story of 4 other real estate investors and entrepreneurs. They started in real estate, or they were burned in the stock market at first, turned to real estate, have done really well, and now are finding success in the stock market, augmenting their cash flow. Not a full turning away from real estate. It's just a pivot, complementing real estate cash flow with stock market cash flow. It's called How to Find Cash Flow. It's called How Real Estate Investors Find Cash Flow in the Stock Market, and that link will also be in the description below.
Fantastic.
Anything else?
Yeah, like and subscribe. Tune in for next time when we talk about go into more depth around dividend kings.
Mm-hmm. Absolutely. Thanks, everyone.